Okay, welcome to part 2 of the art of trading a correction. Trading corrections in multiple time frames with multiple units. It's very highly recommended that you've already gone through part 1 and understand all of its concepts. The first half of this part focuses on trading corrections in multiple time frames. Trading a correction in the direction of the trend of the higher degree or the higher time frame makes it a much higher probability trade. Executing a trade on a lower time frame can reduce your capital exposure. So without further ado, let's go ahead and get started with part 2. Okay, let's go ahead and get started with section 1 of part 2 of the art of trading a correction. The subject for section 1 is trading in the direction of the higher degree time frame. What we're going to learn in this section is trading corrections in the direction of the higher time frame trend makes it a higher probability trade. If a trade is going to be executed in the daily time frame, the weekly time frame is the higher time frame. If you're going to execute a trade in the 60-minute time frame, the higher degree time frame is daily. If the lower time frame is 15 minutes, higher time frame is then 60 minutes. If you're going to execute a trade in the 5-minute time frame, you're going to look to trade in the direction of the trend in the 15-minute time frame. Trend direction is determined by momentum or oscillator position. If the higher time frame oscillator is overbought or bearish, only lower time frame short trades should be considered. When the oscillator of the higher time frame is overbought or bearish, it is a signal that a high should be at or near completion or already complete. And that is why you're going to look for only short positions in the lower time frame. If the higher time frame oscillator is oversold or bullish, that's a sign that a low should be at or near completion or is already complete, and you should look for only long trades in the lower time frame. We are now going to look at some examples and apply what we learned about trading ABC corrections in part 1 of the art of trading a correction and look at it at a multiple time frame point of view. Okay, to demonstrate what I mean about the higher time frame trend direction using momentum or an oscillator, we're going to look at a stock, COMS 3Com Corporation weekly data. So if the weekly data is the higher time frame, the lower time frame where we're going to execute a trade or look to execute a trade would be the daily data. The oscillator we are using is the DT oscillator, the same oscillator that we used in part 1 of the art of trading a correction. But once again, you may use any oscillator of your choosing as long as the highs and lows of the oscillator, the bearish and bullish reversals of the oscillator, correlate relatively well with the pivot highs and lows of the market that you're looking at. The bull trends in this example are shown with thick green lines. The bear trends in this example are shown with thick red lines. And as you can see that this oscillator setting correlates relatively well with the highs and the lows, the bull and the bear trends of this market. Let's look at the bull trend from the end of the week ending December 9th to the week of ending February 3rd. And you can see for most of the bull trend, the oscillator was either in the oversold zone or bullish. And now let's look at the bear trend from the February 3rd high, or the high of that week ending February 3rd, to the low of the week ending February 10th. For the majority of this bear trend, the oscillator was either in the overbought zone or bearish. And so as long as the oscillator is in the overbought zone or bearish, we would have looked for bearish positions. As long as the oscillator was in the oversold zone or bullish during this bull trend, we would have looked for long positions in the lower time frame. Let's go ahead and look at COMS daily data, the lower time frame. Weekly data was the higher time frame. We're looking to trade in the direction of the higher time frame. Daily data is the lower time frame where we execute our trades. This is going to be a little bit of a review of part 1 of the art of trading a correction. We have the December 6th low to February 2nd high, a rally with impulsive characteristics, non-overlapping wave patterns, followed by a potential ABC corrective decline with the March 8th low in the typical time and price targets for a corrective decline. Typical price target is the 50 to 61.8% retracement zone of the December 6th to February 2nd rally, and in the typical time target for a corrective low, the 38.2 to 61.8% time retracement zone of the December 6th to February 2nd rally. So as long as the weekly oscillator, the oscillator of the higher time frame, is either in the oversold zone or bullish, we'll be looking for a long position following the next daily oscillator bullish reversal. So let's go ahead and look at what the oscillator position is in the weekly time frame. This daily chart ends as of March 10th. We go to the weekly chart. As of March 10th, the week ending March 10th, the weekly oscillator is in the oversold zone, so we're clear to enter a long position following the next daily oscillator bullish reversal. Let's go ahead and add some bars on the chart, and since we've seen the weekly data, we pretty much know what happens. We got an oscillator bullish reversal, set a trailing 1 bar high buy stop, 1 tick above the high of the current bar, so that would be at 4.75. Trigger the next day, protective sell stop, place 1 tick below the wave C low at 4.32. There we go. Let's go ahead and look at another example. Okay, let's go ahead and look at the next example, which is Euro Australian dollar cross daily forex data. As you can see, the daily oscillator is bearish, signaling there should be a multi-day, several-day bear trend off this May 22nd high. If this is the higher time frame, we would look to enter only short positions on the lower time frame, which would be 60-minute data. Let's go ahead and look at an a Euro Australian dollar cross 60-minute chart. Let's see, off this May 24th swing high to this May 24th low, we have a decline with impulsive characteristics, following a potential A, B, C corrective rally into the typical price target for a corrective rally, the 50 to 61.8% retracement zone of this May 24th decline. Since the daily oscillator is bearish, the higher time frame is bearish, the next 60-minute oscillator bearish reversal would be a short trade setup for a potential wave C high and a decline below the May 24th low. Let's go ahead and see what happened. 2 60-minute bars later, we had a 60-minute DT oscillator bearish reversal. Sell stop to enter a short trade. Place 1 pip below the current 60-minute bar. Short position elected following the next 60-minute bar. So we put a protective buy stop 1 pip above the potential wave C high. And we have a decline below the May 24th low as anticipated. Okay, let's go ahead and move on to another example. Okay, this example is going to demonstrate how trading corrections in multiple time frames can be used with day trading. If you're not a day trader, go ahead and watch this example, but keep one thing in mind. Ideal corrective patterns do not unfold in lower time frames as often as they do in higher time frames. In other words, their ABC corrections are not as prevalent in 3-minute, 5-minute, and 15-minute charts as they are in 60-minute daily charts and higher. Nonetheless, you can still use multiple time frame strategies to day trade. This example is S&P E-mini 15-minute data. And as you can see, as of the May 19th low, the 15-minute DT oscillator made a bullish reversal. This means in the lower time frame, which is the 5-minute time frame, 5-minute oscillator bullish reversals with the low in the 50 to 61.8% retracement zone of the previous minor trend would be a long trade setup. Okay, let's go ahead and look at the lower time frame, 5 minutes. This is the May 19th low in 5-minute S&P E-mini data, the lower time frame where trades are executed. This is where the 15-minute oscillator made a bullish reversal, so we'd be looking for long trades following 5-minute oscillator bullish reversals with the low in the 50 to 61.8% retracement zone of the previous minor trend. Keep in mind, we're not looking for ideal ABC corrections because they are not as prevalent in lower time frames like they are in higher time frames. Go ahead and add some bars. This low is below the 50 to 61.8% retracement zone of this previous trend, so we would not be looking to enter a long position following an 8 oscillator bullish reversal. We'll have to wait for the next correction to the next minor trend. Add some more bars. Potential minor rally here. And we have a low in typical 50 to 61.8% retracement zone of the previous trend, typical price target for a corrective decline. Sixty-minute DT oscillator bullish reversal. Set a buy stop to enter a long position 1 tick above the current 5-minute bar. Look in the 15-minute data here. And you see that the 15-minute oscillator is still bullish. So this is a legitimate long trade, day trade setup. Triggered following the next bar. Place a sell stop 1 tick below the low of the corrective low. We have another potential minor rally complete. If that's the case, there's a 50 to 61.8% retracement of this minor rally. And we have a low here in the typical price target for a corrective decline to this minor rally. And we got a 5-minute oscillator bullish reversal. Place a buy stop to enter a long position. Long trade triggered following the next 5-minute bar. Protective sell stop 1 tick below the low of the corrective low. And we have a rally above the May 19th high. So on May 19th, there are at least 2 successful long day trades trading corrections using more than one time frame. Let's go ahead and review what we have learned in Section 1 of Part 2 of The Art of Trading a Correction. Okay, let's go ahead and review what we learned in Section 1 of Part 2 of the Art of Trading a Correction. Once trend direction of the higher time frame is determined, and is determined by momentum or oscillator position, trades should be executed on the lower time frame in the direction of the higher degree trend. If the higher time frame oscillator is bullish or in the oversold zone, lower time frame oscillator bullish reversals following corrective declines are long trade setups. In most of the examples that we used in Section 1 were ABC corrections. The reason for this is we learned how to trade ABC corrections in Part 1 of the Art of Trading a Correction. In Part 3 of the Art of Trading a Correction, we'll learn how to trade irregular ABCs and complex corrections. Once you go through Part 3, go ahead and come back to this section of Part 2 and apply what you learned using different correction types with multiple time frames. If the higher time frame oscillator is bearish or in the overbought zone, lower time frame oscillator bearish reversals following corrective rallies are short trade setups. Let's go ahead and go to Section 2 of Part 2 of the Art of Trading a Correction. We're going to add an even lower time frame to reduce capital exposure, and we're going to look how each wave of an ABC correction subdivides. Okay, welcome to Section 2 of Part 2 of the Art of Trading a Correction, lower time frame entries. In Section 1 of Part 2, we learned how to trade in the direction of the trend of the higher degree time frame. In this section, we're going to go down a time frame and learn entries in order to reduce our capital exposure. Let's go ahead and go over the main points that we're going to learn in this section. Entering on a lower time frame reduces your capital exposure, which reduces risk and allows more contracts, shares, or lots to be traded. If an ABC correction is unfolding in the daily time frame, the lower time frame to execute the trade to reduce capital exposure is the 60-minute time frame. This is the same idea as in Section 1. If the 60-minute time frame is the higher time frame, then the lower time frame is 15 minutes. If the 15-minute time frame is the higher time frame, you'd execute the trade with lower capital exposure in the 5-minute time frame. In order to effectively enter at or near the completion of an ABC correction in a lower time frame, we're going to learn how each wave of an ABC correction tends to unfold. We're going to focus on how wave C unfolds because that's going to help us get into the trades with lower capital exposure. After we learn about this, we're going to learn how to trade in 3 time frames. We're going to add the higher time frame to trade in the direction of the trend of the higher time frame. We're going to see the ABC correction unfold in the middle time frame. Then we're going to go down to a lower time frame to enter a trade with lower capital exposure. Let's go ahead and see how each wave of an ABC correction unfolds. Go ahead and talk about how waves A, B, and C of an ABC correction usually subdivide. Wave A of an ABC correction usually unfolds in an impulsive pattern, non-overlapping wave pattern, very often in a 5-wave pattern. Wave B of an ABC correction is counter-trend to the direction of the trend of the correction, so it usually unfolds in a corrective pattern, very often an ABC corrective pattern. That's a mouthful, but it will become clearer with the following examples. Wave C of an ABC correction usually unfolds also in an impulsive pattern, very often in a 5-wave pattern. Let's go ahead and look at some examples. Okay, we're looking at the Euro Australian dollar cross 60-minute Forex data. As you can see, from the May 3rd low to the May 22nd high, there was a 5-wave impulsive rally followed by an ABC corrective decline into the May 26th low. Let's go ahead and look at that corrective decline, ABC corrective decline, in detail. you can see the May 22nd to May 23rd wave A decline, for the most part, unfolded in a 1, 2, 3, 4, 5 wave pattern. It's not ideal because wave 4 and wave 1 overlap. However, nonetheless, the 5 wave decline, and then we have an ABC wave B rally. Once again, not ideal, but a corrective 3-wave rally. But now let's look at the 5-wave decline, wave C decline off the March 24th high. This unfolded in a textbook 1, 2, 3, 4, 5 wave decline. Okay, let's now look at the Euro-Swiss franc cross 60-minute Forex data. We have a decline off this April 4th high down to this April 18th low. It's hard to say if it has more impulsive or corrective characteristics, but there is a clearly defined ABC corrective rally off this April 18th low. Let's look at this corrective rally in more detail. As you can see, the April 18th to April 21st wave A rally subdivided nicely in a 5-wave pattern. 1, 2, 3, 4, 5. While the wave B decline off the April 21st high did not subdivide in an ABC corrective pattern, it unfolded in a overlapping wave pattern characteristic of a correction. And then most importantly, the wave C rally off the April 24th low subdivided in a 1, 2, 3, 4, 5 wave pattern. Let's take a brief second to talk about the typical price target for a wave 5 of C. While in Elliott wave terms, there's a lot of different extensions and alternate price projections to project the typical wave 5 of C price target, we're just going to look at the basics. That's the 127% to 162% external retracement of wave 4 of C. Okay, let's look at the Euro-Australian dollar cross example one more time and look at the wave 5 of C decline in detail. Typical price target for a wave 5 of C is the 127% to 162% external retracement zone of the wave 4 of C rally. In part 1 of the Art of Trading a Correction, I demonstrated how to calculate the 50% and 61.8% retracements of a previous trend. External retracements are just like retracements, except they're more than 100% of the trend that you're looking at, and you calculate them the same way as retracements. To calculate the 127% retracement, you take the range of price of the trend you're looking at and multiply it by this ratio right here, 1.27, and because if it's a bearish example, you'll be subtracting it from the high of this price, which is the trend of wave 4. Do the same thing with 162% external retracement. Or you can go the easier route and get a software like Dynamic Trader that calculates them instantaneously. So as we can see, the wave 5 low, wave 5 of C low, ended precisely in the typical price target for a wave 5 of C low, the 127% to 162% external retracement zone of the May 25th to May 26th wave 4 of C rally. Okay, let's go ahead and look at gold. This is 60-minute gold data. Off this March 24th low, we have a potential A, B, C corrective rally complete, and the 60-minute DT oscillator has made a bearish reversal, signaling that a high lasting at least a few to several trading hours should be at or near completion. Let's go down to the lower time frame to see how this ABC corrective rally subdivides. Since we're looking at 60-minute data, the lower time frame is 15-minute data. Okay, here's wave A of the corrective rally off the May 24th low. As you can see, it's subdivided into a 1, 2, 3, 4, 5 wave impulsive rally. And the decline off the May 26th wave A high, the wave B decline, subdivides in an ABC corrective decline. And most importantly, the rally off the May 26th wave B low, the wave C rally, subdivides in a 1, 2, 3, 4, 5 wave impulsive rally, and the wave 5 of C high was in the typical wave 5 of C price target, which includes 127% to 162% external retracement of this minor wave 4 of C decline. 15-minute DT oscillator made a bearish reversal. A decline below this minor wave 4 of C low would signal wave C should be complete. And that's exactly what happened to a decline below the May 24th low. One thing I do want to mention before moving on to an example using 3 time frames is if wave C is not unfolding in an ideal 5-wave pattern, simply do not enter the trade in a lower time frame. Doesn't mean it's still not a good trade setup. If wave C appears to be completing at or near the typical wave C price and time targets, just use one of the trade strategies that was explained earlier in this tutorial and don't go down to the lower time frame in order to reduce your capital exposure. Let's go ahead and look at an example now using 3 time frames. Okay, let's go back to the first example of this section, the Euro-Australian dollar cross forex example, in order to explain how using 3 time frames can be very beneficial to your trading. As you can see, the rally off this May 4th low subdivided in a nice 1, 2, 3, 4, 5 wave pattern up to this May 22nd high. And then the May 26th low is slightly above the 50 to 61.8% retracement zone of the 5-wave rally, which is typically the price target for a corrective low. As of the close of the next trading day, which is the May 29th close, the daily oscillator reached the oversold zone, signaling a low lasting several days. A corrective low should be at or near completion. Let's go to the weekly time frame, the next higher time frame, to see what the trend direction is. As of the close of the week ending May 26th, I have 2 oscillators up. The 13th setting of the weekly oscillator made a bullish reversal, and the 8th setting of the weekly oscillator is bullish with only the fast line in the overbought zone. This signals that the trend should be up for at least a few more weeks, that the direction of the trend of the higher degree time frame is up. Back to the daily time frame, let's have a quick recap. As of the close of May 29th, the daily oscillator is in the oversold zone, signaling a corrective low should be at or near completion. Let's now go down to the lower time frame and see how this decline off the May 22nd high is unfolding. And you've already seen this example. This was the first example we looked at in this section. We have the ABC corrective decline, wave A subdivided in 5 waves, wave B subdivided in an ABC corrective pattern, and wave C subdivided into a 1, 2, 3, 4, 5 wave decline, with wave 5 of C in the typical price target for a wave 5 of C low. The 127% to 162% external retracement of the wave 4 of C rally. The 50% retracement of the May 4th to May 22nd rally actually falls within this price target. There are actually a few different long trade strategies following this potential wave 5 of C low, the May 26th low. This is May 29th, and as mentioned before, as of the close of May 29th, the 8 daily DT oscillator was in the oversold zone, signaling a low lasting at least a few days to several days should be complete. The trade strategy that can be used is the one that we learned back in part 1 of the Art of Trading a Correction, the trailing 1-bar high buy setup. Following the next 60-minute DT oscillator bullish reversal, a trailing 1-bar high buy stop to when our long position can be set, If the long position is triggered, you place a protective cell stop one tick below this potential wave C low. However, the pattern off this May 26 low has corrective characteristics. It's actually a consolidation. Not ideal for a trailing one bar high buy setup, so we'd want a further confirmation that this wave 5 of C low is complete, and that would be a rally above this May 26 wave 4 of 5 of C high. So a trade entry setup for a long position could be placing a buy stop one tick above this May 26 wave 4 high. If the long trade is triggered, place a protective sell stop one tick below the May 26 low. While the capital exposure is greater with this trade setup as it is for the first one I mentioned, it's a higher probability trade because you got a minor confirmation that the wave 5 of C low is complete. The trade strategy I'm going to mention is a little bit off the subject, but is educational nonetheless. Following a consolidation in the Forex markets, there's usually a sharp move in the direction of the breakout of the range of the consolidation. So a potential long trade setup would be to place a buy stop to enter a long position one tick above the high of the range of the consolidation. If there's a rally above this high, more than likely there should be a sharp breakout up. But the best trade setup for this scenario would be a buy stop one tick above the May 26th wave 4 high. Let's go ahead and see what happened. We had a trade above the wave 4 high, followed by a sharp move to above the May 22nd high as anticipated. Let's go ahead and do a short recap of this Euro-Australian dollar example. We started off by looking at the daily data, daily time frame. We saw that there was a potential corrective decline off this 5-wave rally, but we only want to take a trade in the direction of the trend of the higher time frame, which is the weekly time frame. The oscillators of 2 degrees, 2 settings of the weekly oscillator, signal that the trend direction is up, so we only want to take bullish positions in the Euro-Australian dollar. Now we go down a time frame to see how this decline off this May 22nd high unfolded. We have an ABC corrective decline. Wave C unfolded in the textbook 5-wave decline into the typical price target for a wave 5 of C low, which actually overlaps the 50% retracement of this May 4th to May 22nd rally. Place a buy stop to enter a long position one tick above the May 26th wave 4 of 5 of C high, because this signals that the wave 5 of C low should be complete. Euro-Australian dollar rallied above this May 26th wave 4 high, and there was a rally to above the May 22nd high as anticipated. This shows how trading 3 time frames can be very beneficial. Lower the capital exposure and make it a higher probability trade. Okay, let's go ahead and review what we learned in section 2 of part 2 of the art of trading a correction. Trading ABC corrections in 3 time frames can result in higher probability trades with less capital exposure. When looking at a daily chart, you want to trade in the direction of the higher degree time frame, which is the weekly time frame. The trend direction of the higher degree time frame is determined by momentum position. You want to execute the trade in the lower degree time frame. If you're looking at a daily chart, the lower degree time frame would be the 60-minute time frame. And you will only want to execute a trade in the lower time frame if wave C of an ABC correction is unfolding nicely in a 5-wave pattern. Typical price target for a wave 5 of C is the 127% to 162% external retracement zone of the wave 4 of C. While a trailing 1-bar high or low trade strategy reduces capital exposure, waiting for a trade above or below a minor swing higher low, such as the wave 4 of C higher low, is a higher probability trade setup as it signals the wave 5 of C should be complete. You as a trader must decide if you prefer higher probability trades but with higher capital exposure or higher risk trades with low capital exposure. The higher probability trades with higher capital exposure is waiting for the wave 4 of C higher low to be taken out. The higher risk trades but with lower capital exposure is using a trailing one bar high or low trade strategy. Let's go ahead and move on to section 3 of part 2 of the art of trading a correction. Okay, let's go ahead and get started with section 3 of part 2 of the art of trading a correction. Section 3 is about trading multiple units. Trading multiple units can result in a profitable position even if your analysis is incorrect. A unit is a specific amount of either shares, lots, or contracts depending on what market you're trading. When trading 2 units, the number of shares, lots, or contracts should be divisible by 2. If you're trading 2 lots, 1 lot equals 1 unit. If you're trading 4 contracts, 2 contracts equals 1 unit. If you're trading 500 shares of a stock, 250 shares equals 1 unit. The price target to exit the first unit should be around the 50% retracement of the wave C trading range. This will become more clear in the next example. And you should exit that first unit using a trailing one bar high or one bar low trade exit strategy. This is just like the one bar high, one bar low trade entry strategy that was taught earlier in this tutorial. Let's go ahead and check out example number 1. Okay, the first example we're going to look at is the gold example from the last section. If you recall, off the May 23rd to May 24th decline, there was a potential A, B, C corrective rally unfolding. The 60-minute DT oscillator is in the overbought zone, so if you go down to the lower time frame, we'd be looking for short positions. This is the 15-minute time frame. And here's the ABC corrective rally off the May 24th low. As you can see, wave A subdivided in a 1, 2, 3, 4, 5 wave rally, characteristic of a wave A, and the wave B decline unfolded in an ABC corrective decline, characteristic of a wave B, and the potential wave C rally subdivided in a 1, 2, 3, 4, 5 wave pattern, characteristic of a wave C. The May 30th high was in the typical price target for a wave 5 of C high, the 127% to 162% external retracement zone of the wave 4 of C decline. The 15-minute DT oscillator has made a bearish reversal. All conditions are in place for a wave 5 of C high. Good place to enter a sell stop to go short 2 units would be 1 tick below the May 30th wave 4 of C low. That would be at 559 spot 9. Go ahead and add a couple of bars. 2-unit short trade triggered. Good place to place a protective buy stop would be 1 tick above the potential wave 5 of C high, which would be at 664 spot 6. Let's now talk about the price target to implement an exit strategy to exit the first unit of the short position. As noted in the introduction to this section, that's the 50% retracement of the wave C rally. Why is this a good place to implement a trade exit strategy for the first short unit? It's in the event that our analysis is not correct and this May 30th high is not the completion of a corrective rally off this May 24th low, and what's actually happening is a corrective decline to the 5-wave rally off the May 26th low is unfolding. The 50% retracement is the minimum price target for a corrective decline. And that's why we would implement the trailing 1-bar high exit strategy once gold hits this 50% retracement. So I've put the exit strategy up on the chart. Once gold hits the 50% retracement of the wave C rally, adjust the protective buy stop for one short unit to a trailing 1-bar high, and you're going to put that at one tick above the current bar that hits the 50% retracement. Let's go ahead and add some bars. There we go. 50% retracement is hit. Protective buy stop is adjusted to, for one short unit is adjusted to one tick above that high, 655 spot 1, and it's exited the next bar. Let's go ahead and talk about the potential price target for the second unit or the remaining unit. The price target for the second unit isn't as objective as it is for the first unit. It varies depending on what the higher degree position of the market you are looking at is in. The momentum position of the higher degree time frame, or what kind of Elliott wave pattern your market is unfolding in. But I'm going to give you a common price target that we look at in Dynamic Traders Group. That's the 127% external retracement of the ABC correction. If the 127% external retracement looks familiar, it's because that's part of the wave 5 of C target that we looked at earlier in this tutorial. But let's go ahead and go back to the gold example and look for the price target for the second unit. Okay, first unit was stopped out at 655 spot 1. Let's go ahead and put up the 127% external retracement of the ABC corrective rally, the price target for the second unit. That's at 628 spot 8. Let me go ahead and clean up the chart a little bit. Go ahead and add some bars, see what happens. We had a gap down, and the 127% external retracement of the ABC corrective rally was hit. So we're going to adjust protective buy stop for the second unit to one tick above that current bar. If the protective buy stop is not hit, since it's a trailing 1-bar high buy stop, just like for the first unit, we're going to adjust the protective buy stop to the current bar's high. And it wasn't triggered. Trailing 1-bar high protective buy stop is adjusted to one tick above the current bar's high. As you can see, it hit the high of the current bar, but the trailing 1-bar high buy stop is one tick above the current bar, so it was not triggered. Go ahead and adjust, add another bar. Trailing 1-bar high buy stop is adjusted again to one tick above the current bar's high. Once again. And it was triggered following the next bar at 624 spot 6. Let's go ahead and do a review of the whole trade. All conditions were in place for the May 30th high to be the completion of an ABC corrective rally off the May 24th low. A sell stop to enter a short position was placed one tick below the wave 4 of C low at 559 spot 9. Sell stop was triggered, short position entered, protective buy stop for the full position was placed one tick above the potential wave C high at 664 spot 6. The price target for 1 unit of the short position was the 50% retracement of the May 26th to May 30th Wave C rally. The last 15-minute bar on May 30th hit this price target, so a protective trailing 1 bar high protective buy stop for 1 short unit was placed. The next 15-minute bar of the next trading day triggered the protective buy stop, so the first unit was exited for some initial profit in the event that our analysis was incorrect and an ABC corrective decline was unfolding to the May 26th to May 30th rally. Now we still have 1 short unit in play in the event that our analysis is correct. This is the completion of the ABC corrective rally and the May 24th low is taken out. And that's exactly what happened. The price target for the second unit was the 127% external retracement of the May 24th to May 30th ABC corrective rally. Next trading day, we had a gap down open, and the first 15-minute bar hit that 127% external retracement, and the protective buy stop for the second unit was adjusted to a trailing 1 bar high. The trailing 1 bar high protective buy stop was trailed for about 4 or 5 bars and was exited triggered at 624.6. Let's go ahead and look at another example. Okay, this is a daily example of TXN, a stock, Texas Instruments Incorporated. As you can see, a potential ABC corrective rally is unfolding off the February 1st low. The February 17th high is in the 50 to 61.8% retracement zone of the January 9th to February 1st decline, the typical price target for a corrective rally. And the 13 daily DT oscillator is bearish. All conditions are in place for a wave C high to be at or near completion. Let's go down a time frame to the 60-minute time frame to execute a trade if conditions are in place. Wave C appears to have unfolded in a 1, 2, 3, 4, 5 wave rally. February 17th is a potential wave 5 of C high. Good short trade setup is to go short 1 tick below the wave 4 of C low at 31.30. Potential initial price target for 1 unit of the short position would be at the 50% retracement of the February 14th to February 17th wave C rally. Let's first see if the short trade is triggered. Short trade is triggered. Protective buy stop for the full short position should be 1 tick above the wave 5 of C high, which would be at 31.86. Let's go ahead and put up the 50% retracement of the wave C rally. And as you can see, it was actually tagged right away to 61.8% retracement. So we'd set a trailing 1 bar high buy stop, which would actually be above the entry, but it will still reduce the capital exposure of the short trade. Protective buy stop for the first unit of the short position was not triggered, so we adjusted to a trailing 1 bar high. Still not triggered. We're trailing. We'll go ahead and add some bars, and there we go. It would have been exited at 30.54, 1 tick above the last trailing 1 bar high. Let's now talk about a price target for the remaining short unit of this short position, which is the 127% external retracement of the ABC corrective rally, which is at 27.86. The protective buy stop currently for the remaining short unit remains at 1 tick above the February 17th potential wave C high at 31.86. Let's go ahead and add some bars. minor swing low taken out, depending on what your stop loss adjustment strategy is, would dictate if the protective buy stop is adjusted to one tick above this February 22nd high or not. So let's just go ahead and keep adding bars. And we have a rally above the February 17th high without taking the February 1st low out, voiding our analysis that February 17th was the completion of the corrective rally off the February 1st low. However, depending on what your trade strategy was to adjust the protective buy stop, if it was adjusted to one tick above the February 2nd high or it remained one tick above the February 17th high, regardless, it was a profitable trade even though our analysis was incorrect. And this is what trading more than one unit can help you do, is produce profitable results even if your analysis is incorrect. Okay, before we review what we learned in Section 3 of Part 2 of The Art of Trading and Correction, I want to touch briefly on a couple of subjects. The reason I'm only going to touch briefly on these subjects is they should only be practiced by experienced traders. These subjects are trading more than 2 units and pyramiding. Once you feel comfortable and you have successfully traded 2 units, then you can move on to trading more units, 3 units, 4 units, even 5 or 6 units. Let's look at this Euro-US dollar example, which is a good scenario when more than 2 units should be traded. Back in November of 2005, in the Dynamic Traders Forex report, which I co-author, we called the Wave 5 low, the November 15th Wave 5 low in the Euro-US dollar cross off the December 30th, 2004 high. This was an ideal opportunity to enter at least a 3-unit long position for a rally lasting several weeks, if not several months. Let's look at some logical places for price targets for each unit of a 3-unit long position. A good place to exit, or at least implement an exit strategy for the first unit of a 3-unit long position, would be the 50% retracement of this October to November decline. The 50% retracement is the minimum price target for a corrective rally to the October to November decline. If in the event our analysis is not correct, and all that's occurring off this November 15th high is a corrective rally to the October to November decline, the 50% retracement is the minimum price target for that corrective rally and a good place to adjust the protective sell stop for 1 unit of the 3-unit long position in order to take minimal profits. Good place, good price target for your second unit of a 3-unit long position would be the 50% retracement of the September to November Wave 5 decline. In the event that our analysis is incorrect, and this is a corrective rally to the September to November decline, the 50% retracement at 1.2113 is a minimum price target for the corrective rally, and once this is hit, the protective sell stop for the second unit of a 3-unit long position should be adjusted to a trailing 1-bar low to secure some more profit. And then for the third and remaining unit for a 3-unit long position should be placed at the 50% retracement of the December 2004 to November 2005 5-wave decline. In the event our analysis is correct and a multi-week to multi-month Wave 5 low is complete in November, this 50% retracement at 1.2654 is the minimum price target for a corrective rally to this December 2004 to November 2005 decline. Once this price target is hit, the sell stop for the remaining third unit should be adjusted to a trailing 1 bar low sell stop. The second subject I was just going to touch upon is pyramiding. All pyramiding is adding units to an already existing position. And the only point I'm going to touch on in this tutorial series about pyramiding is that the criteria for an opportunity to enter a trade in the first place is also the criteria to add units or to pyramid. In other words, if you are already in an existing position and one of the trade setups that we have learned in parts 1 and parts 2 of this tutorial series come up, that is an opportunity to add or to pyramid to your already existing position. The only reason I only touched on these two subjects are they should only be practiced by experienced traders. In the near future, I'm going to get in more depth about these subjects in a tutorial series about advanced multiple unit trade strategies. Let's go ahead and review what we learned in part 2 of the art of trading and correction. Okay, let's go ahead and review what we learned in part 2 of the art of trading and correction, multiple time frames and multiple units. We learned that taking trades in the direction of the trend of the higher degree time frame can result in higher probability trades. And the way we determine the direction of the trend of the higher degree time frame is by the direction of the momentum. If you go down a time frame, in order to enter the trade, if the ideal pattern is present, such as wave C is subdividing in a 5-wave pattern, this can reduce your capital exposure for the trade. Trading multiple units can result in profitable trades if analysis is incorrect, and can put you into position for great profit if your analysis is correct. Stop loss placement is your initial line of defense in the event that your analysis is incorrect. It'll save you from devastating losses. Always, always use protective stops. But your trades can result in profit even if your analysis is incorrect if you use multiple unit trade strategies. If you have a predetermined objective price target for at least your initial unit, you will make a small profit in the event that your analysis is incorrect, and you'll still have a unit, at least a unit, in play in the event that your analysis is correct to reap some real profit. If you combine a multiple time frame trade strategy, a multiple unit trade strategy, and objective entry and exit trade strategies, you should have all the ingredients for a well-rounded, successful trade strategy. So let's go ahead and see what we have to look forward to in part 3 of the art of trading and correction. Okay, we made it through parts 1 and 2 of the art of trading and correction. We learned how to trade ideal ABC corrections, as well as multiple time frame and multiple unit trade strategies. Not all corrections unfold in ideal ABC corrections. The main focus for part 3 is to look at some trade strategies and price and time targets for non-ideal ABC corrections as well as complex corrections. See you in part 3.